You're listening to The Moose and the Loose, your 10 minutes action-packed financial podcast with your host, Mike Yahoo. Hey, what's up, Market Moose? Mike from The Moose on the Loose. How are you doing today? Today, we're going to talk about what does it mean when some people say, oh, this stock is priced for perfection. And we're going to end up this episode with two examples on the Canadian market right now for companies that seems to be pretty much priced for perfection. The idea came after this crazy month of January. Like, oh my God, investing is like so exciting in general, but like 2025 is up on a very high level of expectation of excitement, right? So we got DeepSeek that is crushing AI. We got Trump's and the tariffs, and they're going to happen or not going to happen, or maybe they're going to happen in a month from now. So there's never a dull moment, but these days, my friend, wow, I'm having a lot of fun watching those stories, researching, learning a little bit more about that. And if you want to have a tariff guide, I'm working on one. I'm gonna have like two versions. I'm gonna offer you one. The free version is coming up as well if you are registered to the Moose Market, the Moose on the Loose newsletter. So if you're not on the Moose on the Loose newsletter already, just subscribe at moosemarkets.com/subscribe. So kind of easy, right? moosemarkets.com/subscribe. If you ever subscribe to any of my newsletter, you're part of it, so you're going to receive it. And of course, if you're a DSR member, Dividend Stocks Rock member, you're going to get the full package. That will be coming next week, actually. I'm doing a lot of research, having a lot of fun about tariffs and how they impact and how you can protect your portfolio and how you can change your portfolio a little bit more if you're worried about that. Anyways, a lot of things to come on the podcast, on the newsletter, and of course at DSR. But let's go back now. I'm a little bit over the place today. Sorry about that. Priced for perfection. The idea came actually after I saw NVIDIA being crushed big time in January. After we saw DeepSeek, another AI chatbot similar to Gemini or ChatGPT, showing that they might not need those super high-tech chips developed by NVIDIA to grow a very successful and powerful chatbot. I did an episode on January 29th, actually, so you can go back on the Moose on the Loose if you want to know more about this. But here was the thing. A lot of people were shocked to see NVIDIA dropping by 17% on a single day. And I've seen a lot of chatters about, yeah, well, you know what? NVIDIA was priced for perfection. And now perfection, unfortunately, doesn't last long in the financial markets. And then when we discover that there's a threat, like something that could hurt the company, well, if you're priced for perfection, well, of course you're dropping double digit. That's just normal, actually, and it was supposed to be expected. I was not surprised to see that, unfortunately. So what it means to be priced for perfection, when the market look at a company, two things are going to happen in terms of valuation. You can use the numbers you want, you can use the model you want, the assumption you want, but basic stuff is the market is willing to pay for the profit the company generates right now, plus a bonus or a discount, depending if the market believes the company will grow that profit down the road or actually struggles and maybe get less profit down the road. So a good example of that was BlackBerry back in 2012. At one point, the stock was like the company had no debt and had like about $4 billion in cash and was trading at a PE ratio around like eight times the earnings. But the thing was, the market didn't believe that BlackBerry could continue to generate such a level of profit because it was getting eaten alive by Apple at that time. So the market was already forecasting weaker earnings to come up. So they were not willing to pay for a high multiple. And that's why BlackBerry seems to be trading at a crazy deal. The other side is also something that could happen. And those are like the two examples I want to use today is Dollarama and Waste Connections. So Dollarama currently trading at 30 times the earnings. So it is quite steep. Like to pay 30 times the earnings, the market expects some growth coming from that company. And when I say some growth, I'm talking about like when I refer to the dividend triangle, for example, like revenue, earnings, and dividend growth expectations, probably high single digit to double digit. And that's what I mean by price for perfection. If a business is actually offering 10% earnings per share growth year after year after year, well, it kind of makes sense that you're paying a high multiple for it, right? Because you see that business is thriving, it's generating juicy profits today, and it's going to generate juicy profits down the road. So the market expectations are very high, so they will be willing to pay a high price, and they're going to be happy for that. If you look at Waste Connection, a company that has a perfect dividend triangle, everything goes up pretty much at the same pace, and you have like revenue going up over the past 5 years, 11% annualized growth rate. For EPS is 8%, dividend growth rate as 13.5. So similar to Dollarama, very, very strong dividend triangle. Those three metrics are very high, very stable, and it grows a lot. What's the problem with Waste Connection? Well, the forward P ratio is like 34 times the earnings, like even more expensive than Dollarama. Of course, you cannot compare both because they're not part of the same industry, but just to show you that the market is willing to pay a very high multiple for future growth. So they pay for the quality of the business today, the past performance over the past 5 years. So the company showed very good numbers, very good financial metrics over the past 5 years. And third, the promise of keep on delivering this moving forward. So that is being priced for perfection. What happens when either Dollarama or Waste Connection starts to, like for Dollarama, what happens if the company starts to show like 3% comparable sales growth? That would suck, right? That would not be good. Comparable sales of like 2%, 1%, and then not being able to open enough stores to ramp up like high single digit to double digit revenue growth. Well, then the market will not like it. Imagine that Waste Connections make a lot of acquisition, but then less, like having a hard time to make integrations, paying too much, interest charges hurting earnings as well. And then all of a sudden, the company is not able to keep up with a high single digit to double digit earnings per share growth. In both cases, I would not be surprised to see those stock price to drop by 10 or 20% in a very short period of time. It's just normal. The market will reassess those numbers and they will say, well, we thought Dollarama was able to grow high single digit to double digit for another 5 to 10 years. It happens that it's not the case. Like there's a new competitor in town. They're not able to grow because they're limited by their market, whatever the reason is. But then they will readjust the price. The P ratio will go down. And if the P ratio goes down, well, the price will follow. And if you want a perfect example, we actually had two amazing example right before the tech bubble burst in 2000 with Microsoft and Walmart. Kind of ironic because Walmart has nothing to do with the tech bubble, right? But even then, back then, the company was trading at such a high PE ratio that over the following 10 years, between 2000 and 2010, the earnings kept on rising. So the company was making more revenue and more profit. So earnings and revenue kept on rising for both Microsoft and Walmart, but the stock price declined and then almost dead money, like barely increased. Why is that? Well, PE ratio. PE ratio was just going down because at one point the market was paying like more than 50 times the earnings for Microsoft back then. Kind of crazy. And they were just expecting Microsoft to report such a incredible growth, which didn't happen. So the growth was there, but it was not incredible and therefore was priced for perfection, had to go back to like more conservative valuation numbers, and that's the price for it. So you want to make sure right now, because we are trading close to a all-time high once again, that you do not hold many of those companies that are priced for perfection. Or if you do and you're happy with them, well, it's because you have a very long-term mindset and you don't mind to take a setback of like 10, 15, 20% in a single year, just because the company is not reporting exactly what the market expected. And this is a game that is really hard to determine because sometimes companies price for perfection for like 10 years, and then you would have missed an amazing opportunity. So it's just to know that it is part of the risk that you may have in your portfolio right now. So I hope that you have a second look on those. All right, Moose, that's enough for today. We're going to talk again tomorrow. Until then, don't forget to stay invested.
Hey, welcome to the disclaimer. If you're listening to The Moose and the Loose, you cannot really expect me to give you buy or sell recommendation or financial advice, right? You're here for fun, you're here for information and some entertainment. But I am not your financial advisor, I am not your broker, so therefore I'm not liable if you're losing money after listening to the podcast. If you're looking for some advice, go see a professional. If not, you can enjoy the show and do your due diligence after it.